What's crazy to me is big moves in gold, especially this year, is equal to the value of multiple NVIDIAs. Central banks are buying over 1,000 tons per year. If you're thinking about buying gold or adding silver to your portfolio, here's what's actually happening and what makes sense for Canadians. I'm Brian, CPA, over 15 years in finance. The big picture most people don't understand is there's about 28 to $30 trillion of above ground gold. New supply only grows 1 to 2% per year. Gold went completely sideways through the 80s and 90s while stocks actually crushed it. It was dead money for 20 years. Then something changed. Central banks flipped from selling gold to buying it. They've bought over 1,000 tons per year since 2022. China, Russia, Turkey, they're all loading up. Why is that? Gold has zero counterparty risk. Nobody can sanction it, freeze it, print more of it. It's the we don't fully trust the system asset. Gold and silver totally play by different roles. Gold is purely monetary, it's insurance, central banks hold it, investors hold it, it's a hedge against the system breaking. Silver, on the other hand, is more of a hybrid. About 50% of silver demand is actually through industrial, solar panels, EVs, electronics, medical equipment. That's why silver has way more volatility. It typically moves 1.5 to 2 times more in either direction than gold. So in a bull market, obviously that means higher upside, but also nastier drawdowns. The silver market is also way smaller at 1.7 trillion compared to gold's wild $28 trillion, less liquidity, more volatility. One thing for Canadians to know about gold that maybe no one's talking about is gold is priced in US dollars. You earn Canadian dollars. So when you buy a gold ETF, you're either getting pure gold exposure or gold plus currency conversion. Quick math, if gold goes up by 30% in USD, but the Canadian dollar strengthens by about 15% at that same time, your return in CAD might only be 13%. You're kind of playing two different currencies at the same time. I'm not saying a hedge version's better than an on-hedge version. Just make sure you know which one you're getting. Most people don't even realize they're making two different bets at the same time. How does this fit inside a real portfolio? Gold is insurance, not growth. It can trail stocks for decades. $100 in gold in 1971 is worth about $6,000 today. Same $100 in S&P 500, over $30,000. That's the trade-off. People are interested in gold exposure, maybe up to 5% if you really care about the monetary system risk, especially right now. If you can't explain it in one sentence, I don't think you should own it. Silver, same kind of rule, but if you can't stomach large swings, I just wouldn't recommend to do it. I always recommend long-term buy and holds. Bottom line is gold is a $28 trillion signal that big institution players don't fully trust paper money right now with all the printing. That's what's driving this move. It's not necessarily just inflation. For you, it's insurance, small allocation, hedged on hedge, depending on whether you want currency exposure too, and only if you understand it and can do nothing for 20 years and buy and hold. Please like and follow for more content like this.